Hi, and welcome to Sunday Night Charts. We take a look at the charts to help you with the trading week ahead. I'm your host, Steve Van Meter, and today's episode is all about reflation and speculation as investors are just behind insane amounts of call options on the reflation trade. Will they be right or wrong? You decide. Moving averages, these are the colors on my screen. The 50 day is in green, 100 day is in blue, 200 day is in tan. We do have some updates to the guide of the show today. We'll go over that in a little bit. Price is a general direction the prices are headed. Momentum is a rate of change. A bullish indicator for both is positive, and a bearish indicator for both is negative. Momentum is often but not always leads price. Technical analysis attempts to determine where buyers and sellers are at. Resistance is a level buyers can't break, and support is a level sellers can't break, or resistance is where sellers are at, and support is where buyers are at. Do keep in mind, technical analysis does not predict prices. It can be used to determine the risk of a trade, help with time and trade, and provide the direction to the path of least resistance. Charting offers possibilities, not probabilities, and not certainties. All right, let's get into the data here. We've got the S&P 500 unchanged across the board. No change in price, no change in annual momentum, no change in any of the momentum screens. Let's look at where it is trading at, and we see it's kind of a small roll over here. Bulls would love to see a hit against the 50-day moving average as positive confirmation, although that doesn't seem to matter in the eyes of almost anybody anymore as long as prices go up. But nothing really to say on the S&P. It's just a small roll over here. Maybe that is nothing. Maybe it'll come down and tag its 50-day. Based on momentum, we see it is still a strong trend to the upside. Flipping over to the NASDAQ, slightly different view, largely unchanged. The ultra short term, you'll notice I've reordered these. We now have ultra short term, intermediate, and long term. I didn't like the feel the way it was before. Intermediate term now has flipped bearish. So momentum is slowing down on the NASDAQ. Let's take a look at what's going on there, and same picture as the S&P 500. It's just slightly rolling over, no major change in direction. It's done this several times and has not slowed it down. Again, if you're bullish on tech stocks, broad equity, U.S. equity market, you'd love to see a confirmation against a moving average, with the 50-day obviously being the closest one. Will it happen? Wow, who knows? Trend is still your friend. Everyone is still bullish as we go into earnings season. Russell 2000, no change there. Everybody is wildly bullish, wildly speculative on the small caps. And let's take a look at the charts. The challenge is when there's really not much to say on the charts, there isn't much to say. And you have this just massive move higher in small caps, as everybody is betting on massive corporate profits due to stimulus and reflation. Will they get it? Well, if they don't, they've really overbid the price of equities here. No doubt about that. And even volatility is fairly muted. You see it's kind of maybe in this large rounding, bottoming pattern. Will we see volatility get up into the 30s again anytime soon? Hard to say, because there's just been a massive or a lot of volatility crushing to keep volatility low, keep equity prices high. Let's go on to what we've got next, which is the energy sector. Now we've gone from, remember, we were all bearish on the energy sector, right? The market was so bearish, and now it's completely opposite. It is overly bullish on energy, believing that demand is not just coming back in a small way, it's coming back in a massive way, with everybody wanting to go use crude oil. And, one of the factors that people have to be aware is in a liquidity crunch or a situation where there aren't a lot of dollars out there, rising prices act to tighten financial conditions. That's why you see product builds. Why I'm really interested in product builds. Unless those product inventories come down, this rally in crude will eventually turn the other way. I was kind of hoping it might go sideways across, touch the 50-day. It didn't. Everyone got bulled up again and rallied up to near the recent peak in June. Will this be another sign of reversal as it was then? We know sellers are here. Are they going to still stay at this level and push prices down? You still got plenty of moving averages here, so you can still be bullish on the energy sector, but it would be more prudent to get a confirmation against a moving average to add as a level of support. But again, watch the product bills. Those come out Wednesday with the EIA data. On to financials. Everyone, again, is super bullish on the banks, getting a lot of people to borrow money, making a lot of money on loans. Again, this doesn't make a whole lot of sense with 20 million people unemployed and businesses in very uncertain states of where they're going. But you can look at the financials. Everyone's just gone crazy on that. Again, you have the most speculative market in history. People are just taking wild bets. We've looked at the call option charts. You can see people are just taking wild bets, forcing the dealers to hedge, buy the underlying security, drive prices up, forget fundamentals, forget anything. It's all about how long this can go before it eventually pops. And so right now you've got financial stocks at all-time, I think they're at all-time high. Let's see. Let's zoom out. Yep, financial stocks pretty much all-time highs. All right, let's see. Yep, right at all-time highs, which is crazy because given the low interest rate perspective, banks are certainly not making the kind of money they need to support that. How about the utility sector turning red last week and staying red this week? No major change other than the fact that the utility sector is no longer in favor. Somehow people no longer interested in utilities. Annual momentum remains negative. Usually that is a point where when you see annual momentum on a negative trend, which it is now, that is where you either hedge or sell a position, but it's holding out there. I mean, it's hanging in. There's no sign that this thing is falling apart yet. So we'll see where that goes. But I just find it interesting how people were crazy bullish on that. Now they're no longer bullish on that. Industrials, we've already looked at the S&P and the NASDAQ, so we'd expect the industrials to be bullish. No change in industrial stocks as everyone is, again, still bullish on U.S. equities. But let's get into something more interesting, which is the gold mining sector, because what we see is a lot of flip to bearish now on price. Any momentum flip bearish on the ultra short term. This is so noisy, it's not really a big deal. The 3 and 6 months remain negative and heading deeper negative. So there's a color change, which we'll get to in a little bit on this. So what is going on with gold miners? Because one thing that people don't understand about gold mining stocks is they're a fantastic indicator of liquidity. And we talked about this before in the macro show, where if you start to see gold mining stocks head down and broad equity prices head up, it is not a good sign for the broad equity market. Now, for gold mining bulls, you can say, well, it's just coming back down here into its bullish flag. This will be okay. And maybe it will be okay. But if prices continue to fall on gold mining stocks, it's an indication that liquidity in the markets is drying up. And now you're facing a repeat of a potential March event, or even perhaps there's a deeper insolvency event bubbling underneath that we just can't see. So this decline in GDX is not positive for the broad equity market. I've shown this before where you can see, let's overlay the S&P 500 just to give you an idea, because some people had some questions on that. And you can see that when GDX, and here we go back to the great financial crisis, it was leading as equity prices were headed up, and all of a sudden, boom, you saw the broad equity market come back down with it. We've seen that case here back in March. Let's zoom in a little bit. You can see how GDX started to lose its trend and started to head down, brought the broad equity market with it. So it's a great proxy for liquidity. If you can keep an eye on it, that could be a good tool for you to watch going forward. Let's go on to, we've got emerging markets. Now, emerging markets are also, because there's a very similar path that emerging markets go with gold mining stocks, that you'll want to take a look at this. So no change in this, as emerging market stocks, I think, are now at all-time highs or darn close to it. Let's take a look at EEM, and I'm going to show you where the opportunity is here. So you see, look, wow, tagging pretty much right at all-time historic highs. Now, you look at gold mining stocks and say, well, wait a minute, They aren't at all-time highs, potentially coming to lower, signaling potential major liquidity event, and yet you have emerging market stocks up here. So where's the opportunity? Now, you have to look at this one of two ways. Either you're so bullish on the reflation trade, you're willing to buy this hoping it breaks out and brings everything up with it. Or you look at GDX and you say, well, wait a minute, which one is going to be right? Well, if you overlay GDX, what you find is they generally trade together because they're very similar in terms of their proxy of global liquidity. And you can see GDX came down here in 2013, eventually brought emerging market stocks down with them. And then they rallied up for a bit together before emerging market stocks kind of continued to go. And then they reversed because GDX didn't. And then GDX took off and EEM was just hanging out because GDX was lagging. They both went down in March. We'll zoom in here on the 2-year scale. They both went down, and now emerging markets is, see how it's going up? GDX is going down. One of these is right. So if you think emerging markets is right, then you're a big buyer of GDX. If you think emerging markets or GDX is right, then all the people that are sitting on massive call options on emerging markets are headed to slaughter. And so that would give you a potential short position on GDX to take a look at. GDX on EEM. Wow. All right, on to what do we have next is the bond market. Okay, now some of you pointed out that, hey, when everything's really green or really red on Steve's screen here with momentum, that means a potential change is coming. So we now have 3, 6, 9 month all negative. So those are all red. Annual momentum on the 12-month scale. This is a different formula down here at the bottom. So 12-month down here is still green. Everything else unchanged. Let's take a look at the price chart of TLT. Because it appears all of those massive selling by the quants is over, is underneath that. Remember we talked about that 1.1 level being where they would go back short. My guess is that now that we're under 1.1, depending on where their formulas adjust to every day, that's pretty much over. We're not seeing any heavy selling here. We're seeing buying support come in and hold prices up. There's lots of gaps. Now, some of you, really are interested in gaps. You see, gap here and gap up here. There's a gap at the all-time high. There are gaps up there that eventually need to get filled. So there's been now 6 months of pretty much persistent selling. We know the CTAs are done. What we would want to see for this to be a trend change is TLT to start rising off of this level here, and then that will push the moving averages up and close out these gaps, and then you have your trend change. So you may be bearish on bonds, but remember, when you see all red, that could mean where the opportunity is at. High yield bonds, only slight changes here. Short and ultra short flipped on annual momentum to bullish. Ultra short terms flipped back bearish on price. Let's go take a look at the high yield bond market. And this sometimes leads the broad equity market. So far, it's saying that everything's cool. No major demand here to drive high yield bond prices higher. We know the Fed is now out of the high yield bond market buying game that everyone says was so bullish for these, and yet no one seems to be selling them. So no real change here. Still sitting under its 2-year high. Nothing to get too excited about in terms of positioning that. How about gold futures? Now bearish across the board, 3-month momentum flipping bearish as well. Over to red. Again, this is back to that proxy of liquidity. If you really are believing in the reflation trade, you really want to see gold go higher. It dipped in overnight trading on Sunday night down into this below 1820 into the support zone, popped out of it. I don't know where it is at time of recording. But again, if you are bullish on reflation, then you are buying gold at every opportunity. If you're bearish on it, well, then you want to see it break down between 1800. What you want to see if you're bearish on reflation is you want to see gold break down and bond prices rise. And that tells you a liquidity crunch or an insolvency crisis is right around the corner. How about silver? Kind of a mixed bag, mostly changes over to bearish on the ultra short term, and then intermediate term on annual momentum flip bearish. There shouldn't be a major difference between gold and silver. Remember, I said it had to get through this upward resistance level at between 27 and 28, got rejected there. And now the next path for gold or silver, it needs to hold this $24 range. If not, then you're looking at, the high 22s. And if it can't hold that, it breaks down. So, silver bulls, you got your work cut out for you here for sure. And then last but not least is the dollar. And here we got some updated color schemes for you. So dollar still remains bearish across the board, but you now know we've got gold or yellow, whatever color, orangish yellow, whatever you like. 3, 6, and 9 month went from red to gold. Now, what does that mean? Why did I change that? Because one thing that I look at in annual momentum or in momentum trends is it going further negative or is it rising off of that negative bottom? So, and is it turned positive? So what gold now means is it's rising off its negative bottom. It has not turned back to positive. When it turns positive, we'll use that as our green color. So this is a good indication that we're starting to, or a potential indication we're starting to see a bottom in the dollar. Now, does it mean it is the bottom in dollar? No, it just means that it is a potential, and we can look at this on a price chart. What do we see the dollar's looking at, facing is 50-day moving average, oftentimes expected to be rejected there. I mean, usually when you come off of a bottom, you're going to see a rejection at the 50-day, a pullback, and then you'll see further attempts at it. So far, again, looks like a bottom. We saw this kind of pattern over here before, but now what we've got is the 50-day moving average is a much tighter range with prices. So potential bottom, we'll find out, but we're seeing some early indicators. Are these tradable? Not yet. You want to see some more, but we're seeing some of those counts in the screens start to get close to giving a potential indicator. Of course, we'll update that, and maybe that will be the first issue of the newsletter when I get it done. We'll see. Anyways, I'm Steve Van Meter. Thanks for watching. Appreciate you being fans, and we'll see you on the macro show on Wednesday. The content of this video provides educational information only. It's not intended to provide investment or other advice. Still, it's not to be construed as a recommendation or solicitation by our son, security and financial instrument, or to participate in a particular trading strategy. This video was prepared by Steve Van Meter personal capacity. Opinions expressed in this video that do not reflect the view of Alice Financial Advice Inc. or Steve Van Meter Financial.